education to thousands of employees in that region, but I do cover quite a bit of the United States as well throughout my travels. So today, again, we're going to be covering credit scores and how that's important. So let me advance the slide. And as I mentioned, the topic for today will be credit, and specifically your credit score and how this one number can influence our ability to save money. So most Americans don't fully understand how the credit scores work or how they're even determined. So in the meantime, this number has become increasingly critical, especially today with banks and lenders putting loan applications under the microscope. So the days of easy lending and borrowing are really over, which is a good thing, but ultimately what this means is that consumers need to do everything they can to perfect their credit reputation, and our reputation is largely reflected in our credit scores. So what is a credit score? It's something that obviously affects all of us. So if you carry a credit card, student loans, a mortgage, a car loan, then you have a credit score. And the score is a number that reflects your credit worthiness. So in other words, the risk of you not paying a loan on time, or really ever, from a credit card balances to car loans to mortgages, as I mentioned. So it's a number typically between 300 and 850. Obviously, the higher score, the better. But really, you actually have three credit scores, and here's why. So the most widely used credit score is the FICO score. And FICO, which stands for Fair Isaac Corporation, crunches and issues your scores to lenders. So your score is really based on information collected by each of the three major credit reporting agencies, that being the ones you see on the slide here, TransUnion, Equifax, and Experian. So each of these agencies actually issue a credit report, and FICO crunches one score from each of these reports, and lenders typically look at all three scores. And then briefly, there's actually a generic scoring model called the Vantage score. And Vantage score is actually created in 2006 by these three major credit reporting companies, Equifax, Experian, and TransUnion. And it's a slightly different algorithm with a little more weight given to how much debt you're carrying. So unlike the FICO, which is more concerned about your age and credit history, as I mentioned, this has more weight in regards to the debt you're carrying. So compared to the FICO score, which as I mentioned ranges between 300 and 850, the Vantage score ranges actually between 501 and 990. Anything above 900 is considered an excellent score. So now let's talk about how your credit score matters and why it matters for many reasons. For one, it really determines your eligibility to obtain credit, and 90% of the largest banks use your FICO score when determining your eligibility for loans and your interest rate. So if you're hoping to buy a house, a car, go back to school, really chances are you will need a loan. A poor credit score may prohibit you from even qualifying for a loan. So even if you do qualify for a loan, you actually may even be subject to higher interest rates, which really means paying more for the same loan product than somebody else with a better credit score. So typically a score with 720 or better is considered great. So maybe you're not in the market for a house or a new car, but having a good credit score also helps with obtaining credit cards with more reasonable rates, qualifying you for lower auto and home insurance, which obviously means more savings, landing that apartment. Again, recently looking at a few apartments in the Southern California region, they do in fact do a credit check, and even getting that job. Many employers that I've gone out to also run credit checks before hiring. So let's kind of break it down and into the credit score ingredients. And first, let's start out with payment history. So it's actually the biggest chunk of the pie, and it's about 35% of your credit score calculation. It includes how well you pay your bills on time, whether you have any past due bills or bills and collections, and whether you've declared bankruptcy. So again, 35% is that payment history. Now the next one, the 30% chunk, is the amounts owed. So this is equal to, like I mentioned, 30% of your credit score, and it's also known as your debt to credit utilization ratio. I'm going to be mentioning that a few times throughout the presentation, so keep that in mind as well, debt to credit utilization. So simply stated, it's really equal to the amount of debt you're carrying on all your credit cards versus the monetary limit on all of those cards. So just a quick example, if you're carrying a balance of $200 on one credit card and let's just say the limit's $2,000. Your debt-to-credit utilization ratio is 10%. So the lower your amounts owed or debt-to-credit utilization, the higher your credit score. So again, I'm going to be mentioning that in a few future slides, so just keep that in mind. Length of credit history is the next one. That's about 15% of your credit score, and it's equal to the time since your credit accounts have been opened. So again, that's about 15% of your score. New credit, so that's equal to 10% of your score, and it reflects the number of credit cards and other loan accounts you've opened, as well as any credit inquiries placed on your credit report recently. And then finally is types of credit used. This is the final 10% of the pie of your credit score, and it takes into account the different types of credit on your file. So actually, let's just take a look at the average FICO credit score in the country. And as of January this year, the FICO score was 692, according to Experian, one of the three major credit reporting agencies. Now let's take a look at the states from worst and the best states. So again, this is just giving you some facts and letting you know where demographically some of the best credit ratings and some of the worst are. Some of the worst: Nevada and Texas, Mississippi, Louisiana, and South Carolina. Some of the best states with the highest credit ratings: Minnesota topping the list, South and North Dakota, Vermont, and New Hampshire. So again, just giving you a list on what some of the worst states are and some of the best. And as I mentioned, the average score as of January, about 692. Now really the point of learning all of this is really to ensure you get to keep more money in your pocket. A healthy credit score really means lower interest rates and savings that can be used for retirement, sending your kids to college, buying a new home. For me, I work specifically in retirement services, educating people about 401ks, 457s, and I always talk about that compound interest over time. So really with these few examples, I'm going to talk about how compound interest can really negatively affect you, or if you properly plan, how they can positively affect you. So for this example here, let's take a look at a healthy credit score in action. So this example right here that you see on the slide is mortgage interest. So to qualify for the lowest interest rate on a mortgage today, you really need a credit score of at least 760 or better, according to FICO. Let's say you want to apply for a $300,000 mortgage, and the average interest rate on that loan with a top-notch credit score is 4.2%, according to FICO. So your monthly mortgage payment would be around $1,467, again, $1,467. So over the life of the loan, you will have paid around about $528,139. Now, if your credit score was 100 points less, or 660, your interest rate on that same loan would be 4.8%. It's only about 60 basis points higher. So monthly payments would come out to actually $1,574 or $566,637 in 30 years time frame. So that's really a difference of about $107 a month, or a grand total of nearly $38,500. So if you think about it, if you invest that $107 into your retirement plan at an 8% rate of return over the last 30 years, you really have approximately almost $170,000 over that 30-year period. Now you're wondering, where does that 8% come from? If you kind of take a look at the history of the stock market, your S&P 500, your bonds market, your cash investments, over the last 20 to 30, and even last 80 years of the stock market, again, your S&P 500, the average has been around 8, 9 to about 12%. So 8, 9 to 12% has been the average of the S&P 500, and your bond market is around 6 to 8%. So when I give out interest rates, I don't like to have expected rate of returns over 10%. And so just keep that in mind. If you're to save that money at an 8% rate of return, you're going to have almost $170,000. So it's that compound interest over time that really has positive effects on the account. Now, next example is credit card. Most of us on the phone today probably have at least one credit card. And when you apply for a card, you'll see that the fine print will state the APR of annual percentage rate as a range. So it might say 12 to 20% depending on your credit rating. So if you have excellent credit, you'll most likely qualify for the 12% rate. Poor credit, you'll probably face the 20% APR. So let's see how this plays out if you carry a balance on your card. So let's just say for this example, you have a credit balance $1,500 with a 12% APR. The minimum payment, $30 a month. Payoff time will take about 9 years. Your total interest is $894. So $894 is the total interest. A $1,500 balance with a 20% APR. Again, minimum payment's $30 a month. Payoff time is actually 19 years as opposed to the 9 years. And your total interest is $3,668. The difference, $2,774. So that's additional 10 years of payments equal to about $23 a month. So if you invested, again, that $23 a month into your retirement savings plan at an 8% rate of return over 10 years, you'd have about $4,280. So that's why having a good credit score really helps. And this actually gets into our next topic about ways to boost the credit score and how to get those lower payments. So let's talk about the specific ways on how you can improve your score. And obviously improving your score is a huge difference because interest rates, again, on credit cards, mortgage, sometimes those few basis points can mean a huge difference, especially the longer you keep that loan outstanding or you keep that balance on your credit card. So the more aggressive you are with these steps, the faster you can see your credit score improve. The first one I do this for myself. I've been doing this ever since I opened up a credit card. Paying on time. Right now it's probably the easiest thing to do with automation. Everything can be done online, so you can set up automatic payments. But really, this is the biggest and most important step towards a stronger credit score. As I mentioned, this variable compromises 35% of your credit score. So if you're forgetful, have a tendency to miss payments or deadlines, you should immediately and definitely automate the bills. Again, I do this on everything I have, from car payments, credit cards, student loans. Luckily, I finally paid off student loans last year. Best thing to get rid of, and doing that automatic payment just keeps it so I don't fall behind. So really think of it as boosting your credit score in autopilot. The second one is don't carry a high balance. So if your goal is to keep your credit score well into the 700s, you don't want to be carrying too much debt month to month on your credit cards. So in fact, according to FICO, top-tier borrowers who have scores of 760 and above have an average credit card utilization of just 7%. So to get on the right track, just start paying your credit card off in full each month, or pay more than the minimum. That actually gets into my final bullet, pay more than the minimum. Paying just the minimum is really like being on a treadmill to nowhere. It'll honestly take you decades to pay it down if you stick to the monthly minimum. I'm going to flip back actually really quick. I mentioned that tale of two credit card, $30 monthly minimum. If you look at the 12% rate and the 20% rate, again, payoff time 9 years to pay off $1,500 balance for 19 years, depending on what your APR is. That's why I try to pay more than that minimum, because it's really going to cut that time off. So as I mentioned, on an average, let's just say $9,000 balance with a 15% interest rate. Paying the minimum means you'll be done paying it off in 27 years. As I mentioned, the other one, 19 years. So in the end, not only have you harmed your credit score, but many times you're going to be paying way more in interest than you originally started with. But if you pay, let's just say, an extra $50 a month or whatever it might be, you can get out of debt much, much quicker. So really keep that in mind, is paying more than the minimum. I always say this, again, I go out to many people talking about their retirement plans and increasing their contribution 1 or 2%. I was just at an employer last week. I was talking to many young individuals in their 30s and 40s, and many of them, just by increasing their contribution percent out of their paycheck by 1 or 2%, they wound up with another $50,000 to even $100,000 at retirement. So many times, by paying more than the minimum in your mortgage payment or credit card, you can apply that extra interest that you're saving to your 401k. You can really wind up with a much bigger balance, because again, the more you save, the better you're going to be off. Now, another thing I want to talk about on ways to boost your credit score is avoid closing credit card accounts. So this may seem counterintuitive, but really let me give you the lowdown on how closing credit card accounts can really damage your credit score. So the primary reason is that credit card limits can no longer be used towards calculating your debt-to-credit utilization ratio. So I mentioned this earlier, right, that the debt-to-credit utilization, closing them can really lower it. So this could effectively raise your ratio and lower your credit score. So here's a quick example. So take a look at this slide. So credit card A has a $5,000 limit, no balance. Credit card B has a $10,000 limit with a $3,000 balance. So your debt-to-credit utilization ratio with both cards open, 3,000 divided by your 15,000, or 20%. But let's just say you decide to close credit card A. Your debt-to-credit utilization ratio jumps from, and again, doing the math, 3,000 divided by your $10,000, it jumps to 30%. So just take a note, those with higher credit scores in the country have debt-to-credit utilization ratios of about just 7%. Another thing is don't open up too many credit cards at once. I know every time you go to a Macy's or Target or something like that, I'm always hassled to open a credit card. But just be cautious at first. So each time you apply for a credit card, the lender places what's called a hard inquiry on your account. This goes for store credit cards too, as I just mentioned. So multiple credit inquiries, 3 to 5, can really lower your credit score by as much as 30 to 50 points, and the impact can actually last for 12 months, so just about a year. So with that said, if you're shopping for a car loan or a mortgage, it's normal that you have your credit report and score checked multiple times. This doesn't hurt your credit score as long as the inquiries all happened within a 30-day period. So really the way the algorithm works for your credit score is adjusted for these types of inquiries that are less worrisome than, say, inquiries for opening up a credit card. So again, just to reiterate, to keep in mind, as I mentioned, I go to Target and Macy's and so forth, always asking to open a credit card. Just keep that in mind. It may affect your credit score balance, and it, as I mentioned, may last for 12 months. Now, ways to check your credit score. I know there's a lot of misinformation on there and many websites claiming free credit score, but really most of these offers only provide a free credit score if you sign up for something first, which is normally not free. So if you want your actual FICO credit score, you need to go to the source FICO. It's not free. It costs about $20 at myfico.com. You can also get it through any of the 3 major credit reporting agencies: Experian, TransUnion, and Equifax. Prices may vary, but read the fine print. If any site claims you can get a free score, just pay $1. Most likely it's going to require you to sign up for a free trial of some product. And if you don't cancel after the trial period, you will get billed. So again, you can go on Experian, TransUnion, Equifax, get 1 report free a year. However, to get your actual score, you will need to pay for that. So again, just go directly to the source. And just to make a note, checking your own credit score won't affect your score as long as you order your credit report directly from the credit reporting agency or through an organization authorized to provide credit reports to consumers. Now, the second one, to get ballpark estimates for free, you can get approximations of your credit score at the following websites. So creditkarma.com, Quizzle.com, and credit.com. Now, these websites will ask you for information such as birthday, social security number, driver's license ID, all to verify your identity. Now, I have tested all these sites and can tell you they are safe, they are secure sites. And then finally, just ask your lender. You know, again, if you're going for a mortgage, ask the lender or credit card company that takes your credit score into account when evaluating your application. You know, the lender must provide what's called a risk-based pricing notice. So again, the lender is providing you a risk-based pricing notice, which discloses your credit score. Now, this is free. If you're on the phone with a lender or applying for a loan over the phone, you can ask for these scores, and often they'll just tell it to you right over the phone. So again, anytime you're looking for a loan, credit card, mortgage, etc., just ask them. They're going to get you that information for free. So that wraps up the basics on credit. Hopefully those examples help how to lower the credit score and just give you some idea of how they calculate the credit score. Again, there's a lot of misinformation out there, so I really just want to give you the basics and how they break that down. But now I'll open the floor and leave it open for questions. So let me know what you have, and we'll go forward from there.
Thank you, Dan. That was very insightful information. We will now start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can also reach out to your dedicated service team here at Pensionmark. Now for our first question. All right, Dan, what type of credit scores are mortgage lenders looking for in this marketplace to get a quote-unquote good loan?
Personally, I've actually been looking for a residence and went through with one pretty recently back in December. And from what I've noticed, anything, again, they're extremely strict now. Getting a loan is pretty easy as long as you have a decent score. And as I mentioned earlier, about 760 and above is really where you want to be. As long as you make your payments on time, you have a decent debt-to-credit utilization ratio, you should really have no problem getting a loan for, for a mortgage or anything like that. But as I noticed, the really mid to high 700s is what they look for if you want a normal, interest rate. If you want to pay in the 4 to 5% range, you can always pay it down. I know you can, you pay down your points and so forth. But if you want a decent rate, about 750, 760 is really where you want to be. Anything less than that, you're probably going to pay an interest rate that really doesn't make sense in the long run. So from my experience anyway, that's what I've seen in the current marketplace is a high to mid 700s at the minimum.
Thank you. And what are some of the ways a young adult can build their credit score?
And actually, just speaking on personal experience, when I first started in the industry, a very young age, having the revolving credit of college debt, just having a loan from college, really helped me out. I had my cell phone, a single credit card, student loan. I continued to pay those always on time, and really that helped my score. And again, I didn't have a mortgage or mortgage payment or anything like that. My score was very, very high. But continuing to pay off the student loan, credit cards, cell phones, anything you have, insurance, whatever it is, as long as it's paid on time, it really will boost your score. So again, you don't have to have multiple credit cards open, at least in my experience. And even if you don't have a student loan, again, you're going to probably have at least one credit card. If you don't, you may have a cell phone. But as long as you keep that, as I mentioned, that the number one is pay it on time. From my personal experience, that's been the biggest factor. Really, credit companies don't like it when you don't pay it on time, especially in an apartment as well. Any payments you don't make, they're going to report that to the credit agency. And so that's for me the biggest one is paying those any payment you get on time. And again, young, old, it really doesn't matter. I'd say to build up credit, that will be number one. So that's in my personal experience. I'm not sure if you have anything to add on that, but for me, that is number one.
Great, thank you. Our next question, it's understood that some debts cannot be collected after a certain amount of years. If that's so, could you expand on that?
It's actually a great question, and really in regards to that, I really can't elaborate on that too much. I'm not sure specifically of the answer on that, so I may have to get back to you. But that's a really, really good question. I'm actually going to have to do a little more research on that.
All right. Yeah, if you could send the response, and I can forward that on to our viewers. For our next question, then, can you explain any methods to clean up your credit, like making disputes on your credit reports, etc.? Is there a good process for this?
I've noticed that, especially in the world now with identity theft and so forth, if always check your credit report. Again, the three major agencies, you're able to check it once every year. So really, you can get a report 3 times a year. It's free. Obviously, to get the credit score itself, you have to pay for it. But to take a look at your credit report, it is free to look at. So to really clean that up, maybe you missed some payments and so forth. Again, just staying on track. Again, if you missed a few, just continue to make overpayments on anything. As I mentioned, automation. But always take a look at it, because I've talked to a few people, even working 401k, helping individuals rolling over old accounts, and some things I would actually have to do a credit report check for to find the old 401k account. I noticed that, again, with identity theft, some people had illegitimate accounts open for them, and it can really, really hurt your credit score. So anything that you see that looks funny on your account that you may have not opened, again, immediately contact the agencies, FBI, whoever you need to contact to get that taken care of. If you've made any mistakes in the past in regards to payments, really the best thing is to, again, not repeat the mistakes, but to have those automated payments. If you have a few credit card accounts, keeping a low balance on them helps as well. So as I mentioned, that debt to credit utilization ratio, that's a huge portion of what FICO calculates in your score. So the more credit cards you have open and the lower balances you have in all of them, that's also going to help. So really, if you have a lot of debt in your credit cards, paying those off immediately. If you're saving in your 401k, you're saving on the outside, your best bet, especially with interest rates, 12, 20%, the market's not doing 20% today. Again, any investment that you may be in today, unless it's a specific stock, but in regards to the S&P 500, for year to date, it's not earning 20%. So your best bet is to pay off any high balances you have in your cards to at least get rid of the excess in interest you're paying. So for me, that's the best way to really recoup any type of missed payments or rebounding from a poor credit history.
Great, thank you. Our next question deals with the FICO score. Do you have any further information or resources on what the formula is to calculate the FICO credit score?
Yeah, actually, if you go right on to myfico.com, that'll be the best place to go to. Actually, let me just back up the slide here. Go to myfico.com. All the information I gathered was on the FICO website in regards to calculation. As I mentioned about lowering your score, really take a look at how they calculate it, because, again, with the smaller percentages, if you're always pay on time and you have a really good debt to credit utilization, again, that's really only about 65% of your score. So the remaining portion of your score, that other 35%, you may be neglecting, whether it's a lack of credit cards or maybe opening too many at the same time. Check out myfico.com. Really take a look at how they really work those formulas out, the 30, 35%, the 15, the 10, and the 10. From there, you can kind of see where you may be faltering on in regards to your balance. So take a look at myfico.com, and that should definitely help you out in regards to the calculation.
Great, thank you. I think we'll only limit it to a few more questions. We do have a lot filtering in. And so for any further questions, like I said, please feel free to reach out to Pensionmark, and we'll get those questions answered for you. But for now, in the essence of time, we'll ask about 2 or 3 more questions. And the next one is, if you stumble on your credit, how long does it take to repair it and bring that credit score back up?
For what I've seen, it really depends on the type of, hiccup in your credit score. But as I mentioned, with some falters, it can last up to 12 months, some even 7 years. But really, it will take a while to repair the score. So that's why keeping that auto payment, reducing the debt in your various credit card accounts and so forth is really going to help. But typically, the minimum that I've seen, it may take about a year to recoup from a balance. And again, on myfico.com, they will have some details on that. But the minimum from what I've seen is around 12 months.
Great. Our next question, how does co-signing on a loan for someone else affect your credit?
Actually, with experience, I've actually had a friend who recently did that, and it actually does help your score. when you co-sign with somebody. Really what it's going to do, they're going to take a look at obviously both individuals' incomes and credit scores, and many times you can actually qualify for a higher loan, and that's the major reason why individuals will co-sign, and it really does help your score. And so if you have a family member or anything like that and you're co-signing because you will live in that residence, it does definitely help your score from what I've seen from personal experience. So if you are considering it, maybe you need to really boost your score up. It really isn't a bad idea, but again, take a look at the responsibility in regards to co-signing with an individual. It is it's a big, obviously, really big matter. So you really want to take everything into account, but it does 100% affect your score positively. And again, that's if you keep on-time payments and so forth and so forth.
Great. And I think in the essence of time, this next question will be our last. For any further questions that you may have, please feel free to contact Pensionmark. And for our last question, Dan, how, if any, do different debts affect your credit score in regards to credit card debt versus student loan debt versus mortgage debt?
From what I've seen, there's really no discernible difference. Again, much of it just comes from, how much you have outstanding. So for example, with a credit card, they really take a look at how much is outstanding compared to, what your credit limit is. So I guess the same thing really goes into account with your mortgage. They're going to take a look at, how much is outstanding. And so really it depends, but for most, if you have a credit card, obviously a mortgage is going to be a much higher ratio. But really what they're taking a look at is the entire debt to credit utilization is what is your limit and how much do you have outstanding. It does vary, and it's really, it's something where it really depends based on, again, individual and what your net worth is, how much you have in savings, and as I mentioned with the credit card. So that's actually an answer I really can't definitively. It's kind of on a case-to-case basis, so unfortunately I can't answer that specifically, but it really does depend on a case-to-case basis. And that's definitely something that I would definitely contact Pensionmark for some further details on, because then that would be something where I would actually ask a few follow-ups. But that's an extremely good question.
Great, thank you. And with that will conclude our question and answer period. If anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark. Once again, I would like to thank Dan for getting on this call. We really appreciate the information. And additionally, I would like to thank everyone for listening as well, taking the time out of your day. With that, this now concludes our webinar. Thank you.
Thank you so much.